Nuveen's Brian Nick saying he's looking past the cyclical trade and writing the following. Don't sleep on US growth. Rotations into cyclical value can be violent and even durable, but a pause in the rising rate cycle combined with a few more very good earnings seasons are going to give support to tech stocks. Brian joins us right now for more. So Brian, just go through it a little bit more explicitly for me. Are you saying now's the time to buy back into tech?
Well, we never get out of tech, and I think what we're trying to say there is that it shouldn't just be one side of the market that people are thinking about at any given time, because the shifts between growth and value, cyclical and defensive, have been so violent over the last really year and are continuing to be so that I think we have to be prepared for a year in which a lot of different areas of the market perform well, and that at any given time there's going to be some that are in favor versus not in favor. Right now, with I think some concerns about the lack of the vaccination progress in Europe, with a little bit of a backup in rates or fall in rates on the back of the Fed meeting last week, more dovishness from the Fed tends to be good for tech stocks. That right now that seems to be the place the market wants to be. But looking forward, I think as long as we continue to exceed expectations on the economic front, which I think we will, the cyclical trade is still going to have legs.
It's going to act quickly. This market's going to move quickly. And Brian, a little bit later in this program, I'll be talking to Morgan Stanley, and they came out a couple of weeks ago and downgraded small caps just on time. And it's their cycle work that is helping them here. They think we've seen the early cycle trade. It's almost complete, move to mid-cycle. What do you think about that story at the moment, Brian? Where do you think we are in this cycle, in this market?
I'm not even sure we can think about it in those kind of traditional terms, because what we saw last year wasn't a typical recession, and we haven't had a typical recovery. So we may be marching back into some kind of mid to late cycle mode. Certainly, if you look at the credit markets, that's where we are in terms of spreads here in the U.S. But I think the fact that small cap underperformed by so much last year, and that it should be a huge part of the earnings recovery this year, means that we still think that trade has legs, especially if you're looking at financials. The energy names are very levered in the small cap space to the price of oil, and that's what's creating the volatility lately. If we don't think oil is going much higher, that part of the trade may not be there for you over the balance of the year. But I think certainly if you're looking at consumer names, financials, that part of the small cap market should be solid moving forward. And that's where we kind of want to narrow our focus as we're moving into the second quarter.
Brian, typically if I ask the question, what do you think is in the driving seat right now, which asset class, they might say the bond market. Do you think it has been energy in a way that perhaps has been underestimated over the last few months?
I think if you're looking at what parts of the equity market globally are doing well, it's highly leveraged to energy. But energy, I think it's its own dependent variable. And what's causing the oil prices to shoot up is this expectation that demand is going to come roaring back at some point this year, and maybe already has in some parts of the world. Gasoline prices in the U.S., which are obviously going to be dependent on to some extent on crude oil, are also at a very high level for this point in the year. And traditionally, we've seen them even go higher as we head into the summer months. So that's something we have to keep an eye on, both from a macro perspective, but also from a market perspective. Just how is that going to potentially crowd out other sources of consumer demand? How could it potentially add to the bottom line for energy companies? I think the trade here in the equity market has been financials and energy versus utilities and tech, and it's sort of become defensive growth against cyclical value. And it almost feels like a coin toss when you wake up each day, which one's going to be ahead.
And many people are just staying barbelled, Brian. They're just staying with both stories. Tech on the one side, growth on the one side, secular growth themes, cyclical stories on the other side, higher rate stories, energy, etc., banks, etc. Brian, let me ask this of you. I've asked repeatedly through the morning, not asked a when question. When do you think we're fully valued? When do you think this rotation is complete? I want to understand with a little bit more detail what would inform that decision, the signposts you would look for on the road towards that move being complete. What would you look for, Brian?
I would look for a meaningful tightening in financial conditions, which typically would come with more of a rotation out of cyclical value and into defensive growth. We saw that happen really in 2013, 2014 here in the U.S. I don't think we're going to get that for quite a while if you believe everything the Fed has been saying. I completely agree with your barbell comment. Rather than trying to kind of get in and out in these kind of rapid fashion trades and try to guess what kind of trade is going to be in vogue in any given week or month, just holding a lot of everything. And maybe the barbell is the best approach. But in a year in which earnings growth in the U.S. is going to be 25 or 30%, chances are most sectors are going to do quite well, and it will go through phases as the year goes on. But I don't expect financial conditions to be meaningfully tighter at the end of this year than at the beginning. So I'd still look for that cyclical trade, whether it's small caps, maybe it's Europe, maybe it's parts of emerging markets. I think that all those trades can continue to do well.